Let's get a closer look at the good and the bad and the ugly, in fact, in the stock market. For that, let's bring in Doug Cliggott, Credit Suisse's U.S. equity strategist. Doug, good to have you back here on Street Smart. When you look at the market, is there more good, is there more bad, is there more ugly in your view?
Well, I think, Carol, the good news in our view is that when the Federal Reserve was buying assets every week during so-called QE2, we think that was really putting an artificial support under asset prices. And so in some sense, I think we're dealing with much more realistic prices now than we were in the spring or last fall. I think that's the good news.
Doug, I got to tell you, it's a chart that we have quoted over and over here on Street Smart. I want to bring it up for everybody. It's the S&P 500 since the beginning of 2010. For our viewers, the shaded gray areas show when the Fed was buying bonds. The black areas show after the so-called quantitative easing or QE programs. And you see the market just fall off like a cliff. You're saying, Doug, that's happening because there is no more quantitative easing assistance from the Fed in terms of purchasing treasuries and securities here?
I think that's an important part of the mosaic, Carol. I mean, obviously, there's other things going on, and unfortunately, some of those other things going on are a significant weakening of traditional leading indicators of future growth. That's something that I think we're going to be grappling with for many months now. But again, I think as an investor, I'd rather be buying securities when I thought they were on a firm foundation, when I was, really fearful that they might be artificially inflated. So I think from a longer-term investment standpoint, it's actually a good thing that the Federal Reserve's not in there, sort of manipulating asset prices right now.
Well, that's a good point. And I want to talk a little bit about the impact QE has had on treasuries. Let me bring Julie into this, because, Jules, I mean, the end of QE2 certainly hasn't made a dent in the treasury market. Just look at those yields.
It hasn't. And basically, this is a very simple chart to look at. You can look at the 10-year note since June 30th, when we saw the end of the second round of quantitative easing. And who needs QE? Who needs the Fed to be buying when yields continue to push basically to a 2-year low? And you have people that are still buying. And Doug, I'm curious here because it's interesting, even without the Fed, that there's been so much buying, and it looks like it's just a function of folks being worried about what's going on with the economy. Is that your read, and is that what's going on with the stock market as well?
I think it is, Julie. I mean, one of the best leading indicators of growth is the slope of the yield curve. And so with the 10-year yield coming down so much, that really is a very good indicator that the market's expecting weaker growth ahead, maybe much weaker growth ahead. And it fits other data. We saw the sharp breakdown in consumer confidence last week. A couple of weeks ago, we got a very weak manufacturing ISM data point. So I'm afraid, really, the vast array of leading indicator data is pointing to much slower growth, and I think that's why the 10-year Treasury yield's as low as it is.
I want to bring up a point that we heard yesterday from former Reagan budget director David Stockman about quantitative easing. Listen to the almost Perry-esque description he has of that.
It tells Wall Street, load up the truck, short, borrowing money overnight, buy the 10-year, we got your back. In fact, we're going to actually do Operation Twist and appreciate the 10-year. So just lay back, have a nice sleep, and print money for the next 2.5 years. This is outrageous. This is a scam, and I don't agree with the word Perry used, but Wall Street needs to be stopped, and Bernanke needs to be stopped.
Doug, what do you think about that critique of Fed policy?
Well, I think very low interest rates help people that have a lot of debt, Matt. If you don't have a lot of debt and you're trying to save either for retirement or save for anything, very low interest rates are not your friend. I mean, it makes it a huge challenge to try to save out of current income for the future.
So, but that means it punishes people, for example, who are already retired and not those who are working their way up to that, right?
It really does. In many ways, unfortunately, it forces people that have accumulated some saving, it might force them into investments that are more risky than they really desire to be in, just because they feel they have to get higher than a zero interest rate.
You know, Doug, coming off of last week, I think for a while we were kind of scratching our heads out of some of the more bullish forecasts that were out there. You're one of the more bearish in terms of your outlook here for stocks. Let me bring Adam in, because, Adam, you actually been tracking what Doug's been forecasting, and you say Doug actually nailed the move to 1120.
Doug nailed it like nothing I've ever seen. Doug, you may recall a couple of months ago, you and I had a conversation offset. I think you'd just been on with Tom Keene, and you said, Adam, I don't really like the market here. I think 1120 is where we're going. The market went to 1119.46. That was the low close. You nailed it within 50 cents. Doug, tell us, where's this thing going? If you got it right that time, I got to assume you're going to get it right next time. Where do you see the market going at this point?
I think getting it that precise is totally accidental. It's very kind of you. We've got a sort of a band of outcomes that we think are likely here. If the leading indicators, if the economy stabilizes, if we're going to stay on this very sluggish but positive growth path, we think the market could slowly grind higher, maybe 1250, 1275. Unfortunately, though, if we continue to get very weak data, if in effect we're on a slope that ends up in a recession this winter, then I'm afraid the market's probably going to be trending lower. So for now, we're thinking, around where we are right now is the middle of a likely trading band. But to hop off on one direction or the other, we really just need some more data, Adam.
You know, it is really confusing, Doug, at this point. I think people are trying to decide, whether or not we go back into a recession, a double dip. We're going to talk about this shortly with two folks who are actually more optimistic on the outlook. A lot of folks, Doug, at this point are saying go into, look for dividend payoffs here. Suzanne, let me bring you in. I want to get Doug's thoughts, but let's bring you in here right now, because we have been hearing more and more about dividend stocks.
We haven't, and Doug just said it. You can't get any yield from a traditional savings account. Do you want to be in stocks? A couple of firms say you want to be in dividend stocks, if any stocks. Goldman Sachs came out today and offered three names: AT&T, Bristol Myers, and 3M. They advised an option strategy, covered call selling to double the dividends of these names, which already have dividend yields above the S&P. Also, we had RBC coming out saying in volatile times you want to be in dividend stocks. They like Amgen and Intel. So, Doug, I'll ask you, where's the best dividend opportunities in terms of sectors that you like? Do you get into the high-yielding names now, or the ones that are going to be growing those dividends?
I think you look for some of both, and we've actually been advocating that theme. We publish a list on a regular basis that we call Better Than Bonds, because it's offering an average yield of about 4%. We think the most attractive places to be are regulated utilities, pharmaceuticals. You highlighted the telecom services companies. There's a handful of integrated oil companies. I think what we're really looking for is both a very healthy dividend yield, but also a balance sheet that's strong enough so we have confidence that that yield ratio, that payout ratio, will stay high and grow over time. So we're 100% on board with this idea that, good yield, low beta, strong balance sheets are the places to be in the equity market.
Doug, we got to run. Thank you so much for giving us so much time. We appreciate it.
Thank you, Carol.
You bet. Take care. Doug Cliggott, U.S. equity strategist over at Credit Suisse.